Welcome back to another episode of Map Your Money with Arish and Jeff. Have an awesome topic for you today. Talking about kind of our investment thesis. I think it's something we've alluded to, but we haven't really spent a full episode talking about. So thought it'd be good to kind of go through and determine how we allocate our portfolios and how we kind of make decisions on how we want to get invested. But as always, like to start with some sort of icebreaker and start off nice and easy. But the one I have for you today, Jeff, is talking about bucket list, but vacation or destination bucket list. So where's somewhere that you've wanted to go to as far as vacation or destination, but you haven't yet got there yet?
Yeah, this one's easy for me. I've always been a big mythology nerd a little bit, right?
Okay.
And so I always wanted to go to Greece and see like some of the ruins in Greece and kind of like explore the city, take in some of that history. And then of course, I've heard that if you and a group of friends all are willing to spend a pretty penny, you can rent like a catamaran or a yacht and a crew to kind of take you around island hopping in Greece.
Ooh.
So ever since I heard that story, one of my buddies told me that when he was in town a few months ago. That's been a major bucket list item, but you helped me check one off my list of Whistler, Canada.
There you go. Nice. Yeah. Well, Greece is high on my bucket list too. I haven't yet ventured out there, but yeah, it's a good mix of history and beauty with island hopping and everything too. Can't not mention the food as well. So
right. Yeah, exactly. I mean, those people live forever, right? I mean, there's something in the food there. How about you? I mean, you've been everywhere.
Yeah. I always have a pretty long list of places I want to go to. I'm a big fan of like hiking and nature. So Norway is kind of high on my list right now of somewhere I really want to hit. There's some really cool hikes and stuff out there, and it's just insanely serene and beautiful. So
yeah, very cool. Very cool. How about like Banff National Park?
I've been to Banff. Banff is gorgeous. Yeah,
okay.
Yeah.
That's
I do want to go to
of.
Banff in the winter though. I've never been for skiing, which would be really cool.
That would be insane. Yeah.
But yeah, no, that place is gorgeous. So, nice. Well, sounds good. I know summer's right around the corner. People are getting in some trips. I thought it'd be good to talk about. But
yeah, summer's right around the corner as I look out my window and see 4 inches of snow on the ground.
Like we don't quite have that snow. That's hilarious. Yeah. Funny. Well, all right, let's get into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and to help individuals create the roadmap for their financial future. Calls are pre-screened and the content was pre-recorded. Please note that the content presented is for educational purposes only. We encourage you to consult a financial advisor or conduct your own due diligence before making any investment decisions. All information provided is believed to be reliable but is not guaranteed for accuracy or completeness. This presentation does not constitute investment, legal, or tax advice, nor an offer to buy or sell any security or insurance product. It also does not endorse any third party or their views. All examples are hypothetical and for illustrative purposes only.
All right. So like I mentioned, wanted to talk about our investment thesis, kind of how we make the decisions on where we want to get invested, what's the best way to do that. I'll kind of set the framework, give an overall what we try to do, and then Jeff, as our chief investment officer and portfolio manager, would, I guess, kind of love for you to take us through each of those steps and kind of how you make those decisions and how our team kind of goes about making our allocations. But
oh man, we have a guest on the podcast. Just looked over.
I see that. How's it going, Draco? Love it. So I guess the first step that we have is kind of that macro allocation in determining it's a 4-prong approach when we say, okay, how do we get invested? How do we make these decisions in client portfolios? That first step is really that macro economy. What's the best way to see what's going on and what's happening in the world? And it's looking at the macro economy, looking at what's going on across the board with different metrics including inflation, employment, all of these different things that are kind of driving the economy. And then once we determine that macro level, and we'll kind of jump in there a little bit more here in a second, then we say, okay, based off of these macro factors, how do we want to position the portfolios? How much allocation do we want to have to each of the different areas of the market? How much do we want to have to large cap stocks like the S&P 500, for example? How much do we want to have to international, to mid cap, to small cap, to all of these different areas of the stock market, as well as fixed income? How do we want to position fixed income and bonds? And how much of the portfolio do we want positioned to each of these different areas? I know we've talked about crypto as well. How much exposure do we want to have there in these different asset classes outside of stocks and bonds? Once we kind of look at that macro level, determine how much allocation we want to have to each of these different areas of the market, then it's determining that third prong is what's the best way to really get that exposure. How do we get, if we say, okay, we want 10% of the portfolio to be in international developed markets, for example, what's the best way to get that exposure? Is it buying a low cost index and just tracking that? Do we see, okay, there's a fund manager, which we believe with their thesis and their team, they outperform the index based off of the fee they charge, and it's worth it to invest in this manager. And it's evaluating a ton of different managers for each of these different positions or parts of the portfolio, and determining, okay, which thesis do we like the best? Which team do we like the best? How have they done in the past? And how do we think they're going to do going forward, given those first two prongs, that macro prong and the other level of kind of that asset allocation. So once we kind of make that decision on the portfolio managers within that manager selection, then it comes to that fourth step of our process, which is monitoring these different managers and monitoring these different positions and starting back over at the macro level. Things are going to change at the macro level, as obviously we know. And how does that affect our portfolio? Do we want to change our exposure to each of these different areas? If so, do we want to continue with the same managers? Maybe a portfolio manager leaves from one company to another. Were they the reason that the portfolio was outperforming? Was it the team? Was it the thesis? Do we want to jump ship with them to the next portfolio? But kind of a lot that goes into it and making those decisions. But those are kind of the four main, I guess, prongs or places that we start in terms of making those investment decisions. But
yeah, I mean, I guess if you want to break down my job into 3 sentences, there you go. There you go, right? I think, what's important about this is step back and think about the intent of an investor, right? The investor's intent in the market is to generate a return on that asset. Well, how much return? Is 2% a good return? Is 10% a good return? How do you determine what a good return is? Well, what we do as investment managers is we compare it to the level of risk we're taking to earn that return. Risk can be a lot of different measures. It can be maybe a drawdown from the peak value to the trough worst value, and like what percentage decline that was. Maybe we measure the volatility of returns over time, and return series that have wider ranges of volatility are considered riskier, such as stocks versus bonds that don't really have that wide of range of returns at all. It actually just had their worst year, down 13% in 2022, right? And so all of these things kind of factor into each other, right? And so that's like kind of where you want to start, is understanding what's the starting place for a portfolio for the amount of return that you want to earn, and what risk do you have to take to get that? Or what's the maximum amount of risk that you're willing to take, and what is the return that we can generate with that level of risk, right? And so that's kind of the starting point. And so what we do to kind of create that starting asset allocation, and we could do this for a lot of different types of investors, right? We have clients that are going into retirement, are not close to retirement, are in retirement, and they have different needs from their asset allocation versus, based on the returns they need to generate or the risk they're willing to take. And so we go back and we look at all the historical returns of equities, of bonds, of small caps, of mid caps, of international developed, of emerging markets, and we look at their returns. we look at their volatility or their risk. And then third, we look at their interaction with each other. And, this is something that usually the term correlation is thrown out there, or covariance, right? It's not just, well, what do bonds do and what do stocks do in isolation, but how do they do also relative to each other? And what we know is that stocks and bonds are typically inversely correlated. And so it works out really well that when the stock side of your portfolio isn't doing too well, the bond side of your portfolio usually is doing well, and it helps offset that, right? That's that diversification that we talk about. So that's really the first step, is determining, hey, what's kind of that starting point for an allocation for this type of investor, given the risk or the risk they're willing to take or their return goals. And then we assess the macro environment and we say, okay, now we have a starting place. How should we adjust this a little bit given where we are right now in the cycle, right? Do we want to have maybe a little bit additional in commodities or gold because of where we are with inflation in the cycle? And maybe we're experiencing more inflation than normal, and so we need to adjust our asset allocation accordingly to favor assets that benefit in that kind of environment, right? And so that's where a lot of these macro things kind of filter in. And then when you get to the managers, they're really managing the micro, right? They're looking bottom up at these stocks and these companies and understanding what is important specifically to this company. There's a lot of things that are important to all companies, right? That's kind of the macro, GDP, income, employment, interest rate stuff. But the managers are trying to understand what's important for the micro, for this company within that environment, to then generate a return above the index, right? And then that's what we're trying to understand, is how good is a manager at doing that?
Certainly. Can you, I guess, speak a little bit more about why we like using managers rather than choosing the investments or the stocks ourselves? It's very much intentional choice on why we want to use those managers.
Right.
And I'll kind of let you speak on that.
Yeah, it's all about expertise and focus, right? So for me, I'm an asset allocator. I'm really making decisions about how much do I want in stocks, how much do I want in bonds, what kind of stocks and what kinds of bonds do I want to use, and these are decisions that really are affected by the whole macro environment. So that's where I spend a lot of my time. I really want to get the macro picture right. I want to steer the ship in the right direction overall, right? However, the managers, they're not really focused on that at all. They're focused on the individual companies, right? And so I think that's kind of the main differentiator, is that they actually have the time and the focus to go in and figure out all the zigs and zags that are important to this company and figure out the trends and how those things develop to try to look at returns. Something that, I can't go contact, suppliers and customers and have interviews with executives from 500 different portfolio names in the S&P 500. And that's just the large cap index. Right. And then think about, what kind of informational advantage am I going to have on a company, say Amazon, that's covered by probably 30 sell side analysts that cover Amazon and like 9 other stocks? Am I going to have an informational advantage there? Or maybe as a PM going to have an advantage there? So that's kind of the intent. And then another thing is, managers they can give you a different flavor of exposure. Okay. So like within a small cap is a great example. Everybody talks about the Russell 2000 small cap index and how 40% of the companies in that index are unprofitable. So if you want to, but small caps behave a little differently than large caps. There's times in the economic cycle where you want to favor small caps versus large caps. So there is a time where tactical asset allocation wise, kind of that second prong, right? Well, we'll consider that. But then the third prong of, how do I get that exposure? Do I want to use an index or a manager? Well, this is something where you can go find a manager that only looks at small cap stocks, but says, hey, I'm not going to buy these 40% that are unprofitable. I'm going to buy higher quality, profitable companies that have a niche, that have a competitive advantage. Maybe it's just a smaller market, and that's why they're a small cap versus a large cap, but they're still compounding return over their cost of capital, earning returns for their shareholders, right? And so that's another, so they have expertise, right, and focus, and they can give you a different flavor of exposure, right? And so often what you'll see when we use managers is kind of like, in what markets do we want to have kind of different flavors of exposure? Maybe we want mid-cap, but then there's mid-cap value, then there's mid-cap growth, and there could be a huge difference in returns across those, right? So how do we want to use different managers for all those different exposures, right? And then, what other kind of stuff what other kind of exposures do we want from our managers under the surface that we can go grab? Or is there exposure that is not really all that important and we can just buy the index, which is why we use S&P 500 index for a lot of our large cap exposure, but mostly active managers for our smaller cap exposure because of that ability to choose quality companies.
Exactly. I was actually going to make that same point about how it's not just needing to choose kind of a fund manager. We're able to kind of pick and choose. Okay, does it make sense to just follow the benchmark here because we believe, okay, we want to have this underlying exposure, and then maybe we want to have a potential of excess that we could get from a fund manager. And so with like large cap, we have a good chunk of that large cap exposure with basically just the S&P 500. But then additionally, we've added some other allocations in these active funds to be able to get some additional exposure there to fund managers that we believe can differentiate from the index. I know we've talked about the S&P 500 being heavily weighted at the top with that Mag 7, and kind of wanting to get some exposure outside of that as well is really important. And we can kind of do that with fund managers as well. So a lot of value kind of in that third step of picking what's the best way to really get that exposure in these different asset allocations. I know we kind of jumped over that second step. I know you kind of talked about different examples of things that we could see in macro to where, okay, maybe we want more commodity exposure or something like that. I guess, could you speak a little bit more about what's really the process of evaluating that macro level to determine, okay, how much exposure do we want to these different levels in the portfolio? What's the scenario where we want more in stocks or we want more in bonds or whatever it might be?
Yeah, I think number one is the economy operates on a cycle. Pretty much everything operates in some kind of cycle. As a PM of Barron's put it, everything is cyclical, right? And so the number one key for evaluating and using macro for your asset allocation is understanding where are we at in the economic cycle, right? An economic cycle goes through a trough, and then it goes through an expansion, and then it hits a peak in economic activity, and then it goes through recession, and then it troughs again, and then goes through another recession. It repeats, right? And this cycle, this economic cycle, typically lasts, I think the average is like 8 years. It can go on for, I think our economic cycle in the 2010s was record breaking for the US and ended only with the pandemic in 2020 and was going on about, 12, 13 years, right? And so there are certain types of assets that you want to own at certain parts of the economic cycle, right? So let's say, like, right now everybody says we're late cycle. Late cycle is like low unemployment, right? The economy's at full employment. We're operating as we should. We're growing at about trend, right? Or maybe we're actually starting to surpass that a little bit and demand is outstripping supply. So we're seeing inflation starting to heat up, perhaps, right? So that's an environment where you probably want to, start lowering your exposure, right, to super cyclical stocks because we've already kind of squeezed all the juice out of that. You probably want to increase your exposure to defensives. You probably also want to increase your exposure to things like commodities and gold because of inflation, right? Also, at a peak of a cycle, when demand is really high, you would expect to see interest rates increasing, right? And if interest rates have reached their peak, heading to the peak of the cycle, then you expect them to start declining. So it would be a good time to own bonds in your portfolio. Bond prices rise when interest rates fall, right? So those are different things about evaluating. But I think, what I would caution people, and I think what I've been arguing over the last 12 months is, don't see the signs of a late cycle and assume that the party's almost over. Late cycle and mid cycle can last a really long time. In the 2010s, we had low unemployment for several quarters in a row, right? And everybody was kind of looking around like, well, when is this recession coming? I mean, there's an old saying, economic expansions don't die of old age, right? There's always something that kind of happens to create this recession. So, right now everybody's kind of looking at the macro and they're like, oh, looks late cycle to me, better reduce your risk. But I think I would liken this more to like staying out all night at a bar during daylight savings, right? And it's like you're partying, it's 1:59 and it's 2 a.m. and all of a sudden the clock jumps back, right? And now it's 1 a.m. again, and you got a whole another hour. And that's kind of how this economy feels, right? It's like, man, it's late cycle, man, surely, we're about over, right? And it's daylight savings, right? Back to 1 a.m., right? And that's kind of where we are. And I think that's the type of cycle given where economic expectations are, that favors mid and small caps, right? There's a huge valuation discount to large caps because of this expectation that we're late cycle and headed toward recession. Well, what if we're just mid cycle and we never had that early cycle bump in all the small and mid cap stocks because everybody's expecting a recession? Well, in that case, we're due for a huge catch up, and that's what we've been leaning into.
That's a funny analogy because I remember one daylight savings time I was at a bar at 1:59 and it closed at 2. And I was like, hey, it's 1. You can't kick us out. And that didn't really work.
It worked in Columbus. I tell you.
Oh, really? They stayed out?
A whole other hour. And,
that's awesome.
I think I was like one of those guys that kind of looked at my friends and groaned like, all right, yo, okay. It's 2 a.m. in my book, though. Let's hit it.
For sure.
But you're kind of going back to that is evaluating where you're at in the cycle kind of determines the direction of a lot of these things, determines the direction of employment and the level and direction. That's really important. So of employment, of unemployment, of inflation, wages and wage growth, all those things kind of play into it, right? And then those coincidentally affect other asset prices. Stocks do better when economic growth is accelerating versus bonds. Bonds do better when economic growth is decelerating or even negative, right? And so you really have to understand where we are to understand how these assets are likely to react.
Definitely. And I want to add kind of a point of clarity there. I know I kind of went through those different prongs, and we just mentioned, okay, what are situations where we want to change that asset allocation or how to make changes there. That doesn't mean we're going in and making those changes all the time. I think it's very important to understand we're still long-term investors. We're not trying to day trade or go all the cash in any scenario. I know many people see on the news, it's always a big news story when Warren Buffett has a bunch of cash or takes a huge chunk and goes into cash. But I think a big thesis on kind of our investments long-term is that we want to have this exposure to these different areas of the market long term. How much exposure we might have may fluctuate slightly up and down, but we know it's a diversified portfolio that's positioned to weather different storms. You mentioned kind of correlation earlier, and we know that, okay, if this, that, or the other happens, maybe one part of your portfolio is going to do better and another part's going to do worse. But that's something that we've positioned it for, to be able to weather different storms, to be able to ride the waves and
I liken it kind of like to a ship, right? To a ship that's like navigating a not super narrow path between, like, let's say like a couple of cliffs or like a channel, right? And it's not super narrow, but it's not super wide either, right? And it's dark. And there's not really a lot of lights. And sometimes it's cloudy, so you can't see the lights. And what I'm trying to do is just steer the ship in the right direction, right? And sometimes that channel will change and that course will change. And what's required by me as the captain, I need to steer that ship a little bit and alter our course, right? But it doesn't happen very often. It's a slow moving ship. And if you're moving a ship, you're not trying to go back and forth and hit every turn perfectly, right? No, you're just trying to hit it right down the middle of the channel and make sure you're following the general path, right? And that's really what we do. So yeah, our asset allocation changes. It's like a captain at a ship. We're making small changes directionally in the right direction that no one on board really can feel. But at the end of the day, when you zoom out and see it long term, it's we're heading in the right direction and we're following the right path.
So you're saying to refer to you as Captain Cone from here on out?
You can do that. Yeah, I'll allow it.
All right. Okay. I like it.
Sam calls me King Cone, so I get, Captain Cone. That works too.
Well, good. The only last part I really wanted to talk about was just kind of how we do this in tandem going forward and coupling it with a rebalancing strategy. I mentioned kind of choosing the different asset allocations. I mentioned, let's say we say, okay, we want 10% in international, and we decide, okay, we want 30% in large cap stocks. One thing that is important to recognize is these allocations won't stay at that percentage based off of performance. So if, like how we've seen recently, large cap stocks do really well and international doesn't do as well, that 30% will drift upwards and that 10% will drift downwards. And that's by intention too. And what we're able to do there with a rebalancing strategy that we like to do quarterly is say, okay, your international has gone from 10% down to 7%. Let's say the large cap went from 30 to 33. Let's take that 3% of the portfolio. Let's sell high. Those have done really well. Let's sell high, take those profits, and buy international at this lower price. And we think there's underlying opportunity there where we're constantly selling high and buying low, which we think over a long period of time is a great strategy to employ in client portfolios.
Yeah, I think to your point, the S&P is posted back-to-back 20% plus years of return, right? Whereas bonds in this period was essentially flat both years. And so you can think about, okay, if I have a 50-50 portfolio and now the 50 that's my stocks, those are up 50%, and the 50 that my bonds basically did nothing, well, you're going to have a lot more stocks in your portfolio, right? And you need to make sure that, again, what are we trying to do? We're trying to build an asset allocation specific for a client that's matching their circumstances as it pertains to the return targets and the risks they're willing to take. So if this stock risk asset portion is drifting higher, we need to correct that for the client. And when we're doing it via a rebalance, it's really nice because, as you said, we're selling high. We're selling what is outperformed. We can be very confident that we're getting a good price for our investment, and we're selling at a good price, and we're buying what's underperformed. And so it's a little bit of a contrarian view. And on Wall Street, you don't make money by following consensus. You make money by being out of consensus and being right. And so rebalancing us, it means that for the international, right, that's a cycle that has favored U.S. over international for over 10 years. Everybody's waiting for that cycle to start. Well, we don't have to guess because we're just rebalancing over time, right? And so as our domestic stocks outperform, we take a little bit from there, we put it in our international, and we could say, hey, we know we're getting a good price on our domestics because we're selling high. We know we're getting a good price on our international because we're buying low. And if whenever this cycle turns, we know we're there, right? And as it turns out, year to date, international equities indices are up about 10 to 12% in local currency terms, whereas the S&P 500 is up, if I look today, 4.38%, right, as of the close on February 18th, right? And so we're already starting to see that. And it's like for us, well, we rebalanced the whole time. It's fine. Tech stocks go down a little bit. Well, we've been rebalancing out of them, right? So that's fine.
Yeah, definitely. I think that kind of ties it all together in how we believe that we can outperform over a long period of time. And I think it always comes back to this risk versus return, kind of how you started the episode mentioning, okay, how much risk are we willing to take and trying to maximize the amount of return we can get for that amount of given risk. But
and I think we need to be, we need to set expectations too, right? I mean, how many clients we have that come in and say, okay, hey, what do you want in retirement? They're like, all right, it's not much. 10% return, no risk, all liquidity, cash flow paying. It's like,
yeah,
returns in the marketplace are kind of like a drive-up window where you go and you say, hey, I'll take 8% return, please. And they say, okay, that'll be X amount of risk. And that's what it is you have to think about, what price am I willing to pay at the window for the return that I expect to earn? And there's no free lunch there except for diversification.
Certainly. Yeah, I think it's always kind of those trade-offs. And I know this is something I've talked about with clients personally is risk versus return as they look at a real estate investment or an investment in their friend's business. Is the amount of risk that you're taking into that external investment opportunity going to give you the reward that would make sense to merit that level of risk? If it can go down to zero, we need a higher potential return than what we could get on a bond, especially, or even kind of like what we've seen in the S&P 500. So
yeah, we call that excess return, or sometimes we might call it a risk premium, right? And that's kind of an investment term to say, hey, I'm taking extra risk. That'll be more return, please. Right. And or in it from a bond issuer's perspective, it's, I know my bond is a little riskier than others, so I'm gonna have to pay investors more to take that risk. Right. And that's the way the capital markets works. And it helps allocate risk and return and make sure that projects that are risky are finding, flows and being funded from people that are expecting that kind of return. Right. And projects that aren't as risky are not having to, be funded by people like that. Right. And at where we sit right now, you can earn 4% on a money market fund. And so I think it's really important to think about excess return versus risk, because 4% is a decent starting place to earn with no risk.
Yeah, certainly. Well, as always, appreciate your insights, Captain Cone. I know you're guiding our ship.
No problem, matey.
There you go. Well, hopefully you can guide that ship through Greece at some point.
Yes, that's right. Captain Cone needs to be sailing through Greece.
There you go. Definitely. Well, appreciate the time, Jeff.
Yeah, thanks for having me.
Thank you for listening to our podcast. Remember, the views expressed are not necessarily those of Beam Wealth Advisors. All content is for educational purposes only and should not be construed as an endorsement of any third party or their views, or as a solicitation or offer to sell securities or provide investment, tax, legal, or consulting services. We believe the information presented to be reliable, but it is not guaranteed for accuracy or completeness. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not a guarantee of future results. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request or at the SEC's Investment Advisor Public Disclosure website, advisorinfo.sec.gov.